What do you think about what's happening right now with AMC, with GameStop, with some of these other so-called meme stocks?
Yeah, I think you got to break it down, Becky. Good morning, by the way. I think you got to break it down in terms of you got three types of investors. I thought the three of you did a good job this morning talking a little bit about that, but you referenced two. You've got the long-term investor that basically every now and again will rebalance their respective portfolio. But then you've got the long-term investor, though, that also has a strategy where they trade around the positions, where they're trim into strength and they'll add on weakness. They could do 10, 15, 20, 25 trades a month. But then you've got the day trader, and that's exactly what we're talking about now. And the concern I've got is that, you can have arguments why there's a fundamental argument why AMC may be going up. You've got people going back. You've got the John Krasinski movie that got great reviews over the span of the weekend. But then I give AMC a lot of credit this morning for having said that, the fundamentals in their company are not matching the performance of the stock. And that's going to cost them some money in terms of what they're trying to raise. But I give them credit for that. At the end of the day, sometimes you can make a lot of money, and it's not a fundamental trade, though. It's a technical trade. And when the day traders, when they did with GameStop a couple months ago, a few weeks ago, and what they're doing now, it's a technical trade. But what we've got to be conscious of is that at some point, and you said this earlier today, the market's going to turn around. The technicals are going to wear out, and they got to be prepared for a down move in that. But so far, I think they've probably made a little bit of money, and I still would question the institutions that I've heard so far have lost about $5 billion in their shorts. And if they haven't figured out now that they could get hurt through short squeezes from retail, that's something the institutional investors got to learn.
Yeah, that's a lot. You gave us a big, broad overview. Joe, just using the term day trader, it's not something we use anymore. That was the late 1990s, early 2000. Is this the same? Is this different? Does it rhyme?
No, Becky, I think there's a great parallel there. I think the day traders came around in the 90s for a couple of reasons. First, the internet. Obviously, we got great technology today. But second, we had an incredible bull market. The market went bananas there the entire second half of the 90s. Then we know what happened. March 2000, it explodes. We had a very difficult 3-year recession. But we've had a great 5 years of the marketplace. And as long as the markets continue to do well over time, really do well, like month to month, the day trader is going to be okay. If we go into a bad year, the day traders are going to get wiped out. That's what happened in the 90s. That's what would happen this time.
Until then, you would just tell the institutional investors beware. You wouldn't get short any of these things?
Well, I don't think up until Plotnick and Melvin Capital a month or two ago, I don't think any institutional investor thought that the retail market would be able to come together and put them in a short squeeze. But we learned something now. That's what's happening now. Well, the institutional investors, they're sophisticated people. They got to be able to wake up to that. That's a threat that he didn't have, let's say, 2 months ago, but they've got that now. My biggest concern is what's going on with the individual investor, though, and that they've got to be able to understand kind of when they use leverage, what that really means. Leverage on the way up is a great thing. Leverage on the way down can rip your arms off. And I think the Robin Hoods of the world and the Ask Kevins of the world, we got to do a better job of making sure we educate the individual investor who likes to day trade to make sure they understand what the risks are when the markets start to turn around and how to handle it. A quick example. If you bought AMC at 10 and it goes to 20, is that not enough of a profit? It goes to 30. If it goes to 40, at what time do you start to trim that position or, in effect, get rid of the position altogether? They're things that we've got to do a better job of with the day traders.
What, is it education? Is it saying you're not allowed to add more than X amount of leverage? How do you do it? I mean, I think there's been a lot of talk about this and a lot of clear cases where it was a serious problem. I don't know that everybody gets it yet, though.
No, I totally agree with that. Now, with what took place a couple months ago with GameStop, I think the regulators, the SEC, is going to do a good job of looking into that. And I think, for example, should there be some requirements around how you handle a short position? Perhaps there should be. Should there be some requirement? There are requirements right now with regard to leverage, but it's understanding that. So I think it's absolutely, a matter of education. You get carried away when you're making money every week or every month. But when that blows up in your face, you got to be prepared for that. And that is a matter of education.
Hey, Joe, you bring up concerns about the retail investor. And again, you're somebody who's been a champion of the retail investor. You've kind of been there watching this for decades. I think a big part of the concern, though, is if these retail investors get burned and get burned badly, it will turn them away from the markets, an entire generation of people away from the markets. And that's that's bad news. It's bad news for what it means for the markets, but it's worse news for what it means for that generation of people who have turned away from what should be the best way of raising money and saving money over a long period of time.
I think when you make a mistake in the business world, when you make a mistake in the football field, when you make a mistake as an investor, you tend to learn the most from those mistakes. And the concern that you're talking about, Becky, is very, very real. Having said that, at some point in time, the day traders got to recognize that the markets go like this over time. And they got to be prepared for the down moves as well as position for the up moves. And they got to move a little bit from just being a day trader to having a little bit more of an understanding of what a long-term investor strategy should be. And bringing in that discipline with a long-term perspective, even if they don't become perfectly long-term investors right away, just the understanding of moving in that direction is the right thing for them to do. If they love what they're doing and they get burned a bit, that shouldn't send them away from the market, although I recognize that's a risk. That should tell them they need a better education, a better understanding that day trading alone is not going to be good enough to ride out the ups and downs of what's going on with the economy and the markets over the next several years.
Shepard Smith here. Thanks for watching CNBC on YouTube.